at topic number 1. Remember, we are still looking at topic number 1, which is assets stroke what here? Liabilities. Assets stroke liabilities. The subtopic is known as income taxes. Income taxes. And I'm specifically looking at how to account for income taxes using International Accounting Standard number 12. IAS 12, IAS 12, IAS 12, IAS 12. And specifically, I would want to look at what we call deferred taxation. Deferred taxation. Deferred taxation. Deferred taxation. Now, ladies and gentlemen, whenever somebody mentions this word deferred, to defer, what does it mean? What does it mean to defer? What does it mean? What does it mean? What does it mean? So you can, for example, defer doing your CASNEP papers this semester to the future, which will be a very bad decision. So when you defer, you postpone, you postpone, you postpone. And in terms of taxes, yes, there are taxes that we shall be postponing. Why? Because you will buy an asset. You've bought an asset. This asset, for example, is worth 100 Kenya shillings, assuming it's a small asset worth 100. I'd forgotten to delay. Thank you very much, Evelyn. Delay. Great. I'd forgotten to record. It's important that I always record these classes. Thanks. Great. Now I'm recording. Great. So you've bought this asset, in this case here, for example, worth how much here? An asset, for example, worth 100 shillings. All right. So because I've just started recording now, don't forget that we're doing this topic number 1 in our FRA, known as assets and liabilities. We're looking at this subtopic known as income taxes, IAS what year 12, and specifically today, for today's session, I'm looking at those taxes that we shall be required to pay in future. In future, what we are calling deferred taxes. And if I borrow some words that I've seen being thrown my way from yourselves here, somebody has said, for example, defer, to defer is to delay, it is to postpone. So if, for example, I was to buy an asset at say 100 million Kenya shillings, at the end of the day, I will be required here to depreciate this asset. So I'll be required here to depreciate this asset. So if I depreciate this asset, for example, straight line, 5 years, it means that the depreciation here will be what here will be 20. But now remember, my carrying amount here will be what here? My carrying amount will be 80. Carrying amount of this asset at the end of the year will be 80. What I'm carrying to the future. The taxman does not recognize this depreciation. The taxman has his own way of giving us reliefs, has his own way of calculating his loss in value that he'll be able to accept. So the taxman on the other side of the coin, he has his own ledger regarding your financial transactions, regarding how you're building up your assets. So in this case here, you have, this is the financial accountant at RCM, CA, and then we have in this case here, the taxman on the other side, he'll be computing what we call the tax base. Now, ladies and gentlemen, the taxman, of course, also will recognize the cost that you incurred. But you see, the taxman has got his own way of calculating wear and tear. What we are calling ourselves as accountants as depreciation, the taxman on the other side calls it wear and tear. And he has various classes. So he'll be able to come and take this machine that you have. For example, let's say this is a heavy machinery, and they classify this, say, in category 1. For example, I'm not so good at tax, but I'm just assuming that this is, for example, a heavy machine. Let's put it in class 1. And if it's class 1, then this guy may tell you that the wear and the tear should be what here? Should be 20, should be 25. The wear and the tear should be 25, all right? Or wear and the tear, in this case, it can even be nice to you. The wear and the tear, in this case, it will be what? It will be 10, for example. So it means that according to him, his tax base, that we shall be looking at how it is calculated, tax base, which is cost minus accumulated capital allowance, it means that his tax base is what is 90. His tax base is 90. Ladies and gentlemen, remember, you will take to your income statement, the depreciation for the year for this asset will be 20, I mean. But the taxman, in this case here, in your own income statement, is only allowing for what he is only allowing for 10. So automatically we have a difference between the two methods. And this difference at the end of the day will reconcile. At the end of the day, we know that these carrying amounts will go. This guy will have to drive the carrying amount of this thing to zero at the end of the economic useful life. And this guy as well will have to drive it to what, somebody to zero at the end of the useful life. So in this case, it could be giving you some years, is giving you less than you have booked as wear and tear. Some other years, of course, as we progress, remember the taxman wants to incentivize you. The taxman doesn't want to kill you from the beginning, right? The taxman in this case will allow you like some things like intangible assets, where you are carrying research and development. The taxman will allow you to like book in everything. All right. He would want you in this case here to be doing more of research and development. All right. So from the very beginning, he wants to incentivize you. But you see yourself, you're taking this research and development as an asset. You must amortize that particular cost evenly, for example, over 4 years, over 5 years, like that. So the amounts in this case here, you're going to be booking on a year-to-year basis between you and the taxman could be different. But ultimately, we expect in this case here, the asset written down value to be zero. And that is why we are saying that these differences you are seeing here, they are not permanent. They are what we call temporary differences. We call them temporary differences. But now, ladies and gentlemen, assuming this year you've paid little tax for this asset, and for sure you know that you ought to have paid more. Then in this case, prudence dictates that if you have paid less and you are supposed to have paid more, prudence dictates that you must create a provision for future liability, because that tax will be paid in the future. And that provision that you are creating today for future, for example, increased taxes here, is what we are calling deferred tax. Deferred tax. So whenever we talk of deferred tax, always remember that this is tax that is postponed, which will be required to pay in the very future. But remember, for going concern of businesses, whenever you smell that there is some contingent liability in future, there's a liability that will be paid in the future, then automatically it dictates that you have to create what here? You have to create a provision today. All right. So for us to be able to understand what we are talking about this afternoon, I would want us to go through this handout right away. And this is what I want us to look at, ladies and gentlemen. This is what I want us to look at, ladies and gentlemen. Not that one. Let me first of all open this handout here. This is a handout that I would want us to open and look at. Already I've shared the handout with you. So yours, in this case here, ladies and gentlemen, is to do what is to open that handout, and then we go through it together. I've been able to share it there. I've been able to share it with you here. All right. And then remember, when we started, you guys gave me the lucky places that we should be mentioning throughout. You told me, Mwalimu, if you want us to understand this topic very well, our lucky place is Mount Elgon, isn't it? Our lucky place is Mount Elgon. So recognition of current and deferred tax, IS 12 requires that we have to recognize the current and any deferred tax implications. And we're being told here that current tax liabilities and assets are recognized for the estimated taxes payable or recoverable based on the taxable profit or loss. Of course, at the end of the day, you guys must tell us what is the taxable profit. Levy 30% on that. Give us current tax. You should also use the 30% in this case here for your deferred tax. So you're told here deferred tax liabilities and assets arise from temporary differences. They arise from temporary differences between the carrying amounts of assets and liabilities in the financial statements and their tax basis, ladies and gentlemen. I mean, if you understand this concept, would rather in this case here say the class comes to an end, because that is the most important concept of today. The deferred tax will arise not because of permanent differences, but because of what we are calling temporary differences. And the question is, how are we calculating these temporary differences? How are we calculating these temporary differences? This person has already given us the temporary differences formula. He is telling us, ladies and gentlemen, that temporary difference, temporary difference, ladies and gentlemen, according to this gentleman, it is carrying amount minus what they are calling what here, minus what they are calling the tax base, like that, tax base. And then the question is, how do we then get the carrying amount? How do we then get this carrying amount? You guys know that carrying amount is the same as net book value. Carrying amount is the same as who? Is the same as the net book value. Carrying amount is the same as net book value. Is the same as net book value. Carrying amount is the same as net book value. Thank you very much. Ladies and gentlemen, anytime they want us to get carrying amount for them, CA, we shall always be taking the cost of the asset minus, in this case here, any accumulated depreciation. Any accumulated depreciation, like that. Cost minus any accumulated depreciation. Have you guys been able to write up to here, really? Have you guys been able to write up to here? Have you guys been able to write up to here? Please, let's talk. So anytime they want us to give them, carrying amount, what we need to do, like I did for my asset of RSM that I bought for 100 million, I took 100 million divided by 5 to get depreciation. Then after you get the depreciation, you take the cost. The asset cost you 100 million minus the 20 million depreciation for the year. If, for example, it is at the end of year 2, then you take 100 million minus 40. Where have I gotten 40 from? It is from taking the depreciation per year 20 times 2. Because remember, to get carrying amount, ladies and gentlemen, you'll be getting carrying amount by taking the cost minus accumulated depreciation. Cost minus accumulated depreciation. Cost minus accumulated depreciation. Cost minus accumulated depreciation. All right, so ladies and gentlemen, then we get back here. How about tax base? Tax base is exactly equal to the carrying amount, except for the fact that for tax base, it is the taxman who is doing the computation. It is KRA that is doing this computation. So to get the tax base, we shall be taking the cost here minus, in this case here, any accumulated wear and tear. They call it wear and tear. We accountants call it what here? Depreciation. We call it depreciation. Thank you very much, Becky Lizzie. We call it depreciation. The taxman calls it what here? Wear and tear. All right. Now, ladies and gentlemen, having understood this, then we can very fast go to something very, very important here. We can go to something very important. The handout is yours. I know you guys will be able to read. The most other important thing that you're supposed to know is that permanent differences arise out of the stuff that is tax exempt. Anything that is tax exempt or tax disallowed, is not allowed for taxation at all, then it shall not be going to our temporary differences. If you go to a question, then you're told that, for example, goodwill is tax exempt. So if it's tax exempt, then automatically it means that there is no way we will be having, in this case here, any reconciliations in the future being done. If something is tax exempt or tax disallowed, then automatically, ladies and gentlemen, that particular item will fall under what we call permanent differences. You just go to the examiner, not the examiner, but the taxman. The taxman tells you, this one, we don't allow it totally. So it means that there you have what we call permanent differences. Permanent differences. And if there are permanent differences, ladies and gentlemen, then automatically that particular item shall not feature anywhere in our deferred tax computations. They not feature anywhere in our deferred tax computations. Who can give me an example of items that you guys are aware of which are allowed? The accountant will allow them, but the taxman will never allow them. The taxman will never allow them. Fines. If, for example, you are fined today, of course, you as an accountant, you'll be able to capture that fine in the income statement. But trust you me, the taxman will not allow it at all. Not even in a different name. Not even a different name. You know, even depreciation is disallowed. That I agree. Depreciation is disallowed. But you see, the taxman will have depreciation except for the fact that he'll use what here, a different name. But for fines in taxation, what do you do with fines? You always say add back. You always say add back. Let me see the comments here. 7 of them. Great. Like donations, yes. Donations in this case here too, non-charitable, non-registered organizations. If you go and make donations in this case here too, non-registered charitable institutions, then automatically that is your own business. All right, that is your own business. So in this case here, the taxman will not be able to do what he will not be able to allow that. All right. Depreciation, of course, is not allowed, but that one, we shall be featuring it here because, as I've explained, the taxman on the other side will be having just a different term, but the same meaning. You know, you'll be having on the other side wear and tear. At the end of the day, wear and tear and depreciation amounts must amount to the same thing, must be reconciled at the end of the day because they must drive the cost of the asset to zero, both of them, ultimately. You guys are bright. Thank you so much. All right. Then I would want us to straight away go to a question. For us to be able to understand this concept very well. I would want us to go straight away to a question here. And this is the question that we are doing here. It is an old question that this examiner has always been getting. It's an old question which is in our revision kits. And that is why I want everybody this semester to buy our revision kits, which are on offer today. We are selling them for 1,000. There is a limited window of offer. You need to buy our revision kits. And of course, for those following us online and wherever, if you want in this case here to buy these kits from us, simply call 0793 555 000. That is our number. Old is gold. An old question that you'll always get this examiner repeating severally, not once, not twice. So you're told here, June 2012 question number 2, cow. Lamy Limited has a deferred tax liability as at 1st May 2011 over 100 million. So this is a deferred tax brought forward. I love this. For the purposes of preparing financial statements for the year ended 30th April 2012, the following additional information is available. They're giving us property, plant, and equipment has a carrying amount of 1,200 and a tax base of 1,000. Some land and the buildings were valued upwards by 50 million during the year ended 30th April 2012. So we want us just to prepare the temporary differences schedule. Let's prepare the temporary differences schedule. The temporary differences schedule. So temporary differences schedule. Remember, it is temporary differences that will give birth to deferred tax liability or deferred tax asset. All right. So we have here assets, stroke liabilities, what basically are called items as well. And we shall have a column for each one of them. We shall have a carrying amount column, and then we shall have, ladies and gentlemen, apart from carrying amount, we shall come and have, in this case here, tax base, the tax base. And then, of course, lastly, we shall come and have what we call temporary differences. Temporary differences like that. Temporary differences like that. Remember, topic number 1 is called assets and liabilities. Assets and liabilities like that. So let me know, ladies and gentlemen, whether you've been able to draw this table. You don't have to use really like a ruler to do this. Not very serious. You're not drawing a house. Done. Thank you so much. So we start with the first item. Which is property, plant, and equipment. You know, your examiner is a very lenient examiner. If there is an examiner who is a good examiner, is the examiner who sets AFRA. It's normally the easiest paper actually in the advanced level, especially if you know how to prepare. All right. And of course, good preparation is like, Mwalimu has done these questions, you go and repeat them and do them yourself. All right. You will be able to pass this paper very easily. There is nothing that is tricky in AFRA. If you go to an AFRA exam and you get like so many tricky things in the question paper, then know that you weren't very well prepared. When Mwalimu was teaching here, you are not opening your 2 eyes. You're only opening 1. Or for example, when Mwalimu was teaching here, because this is an online class, you are really multitasking a lot. You know, like right now. You will get somebody like, now I'm really sweating, trying to explain temporary differences, trying to explain permanent differences. But I'm so sure there must be a ninja that is eating ugali there. Eating ugali, and here we are dissecting IAS 12 deferred tax. Is there any ninja who is eating ugali right now as we speak? Is there any ninja who is eating ugali as we speak? We shall overcome. Because these things are straightforward. Like, you know, they're telling us PPE, they're giving us the carrying amount, and they've even given us a tax base. All right. So like now they've told us property, plant, and equipment has a carrying amount of 1,200, and then we have in this case here the tax base has been given as 1,000, has been given as 1,000. So then our role this afternoon for a free mark, that is 1 mark, a mark that can make you see places that you've never seen before. Our role will be to determine the temporary difference, TD. Remember, to get TD, temporary difference, we normally take carrying amount minus tax base. 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 Thank you very much, Jeffrey. Geoffrey was almost eating Gederi, but he deferred. In light of in light of our today's topic, deferred taxation, this gentleman postponed this activity. But I'm so sure there must be a great kissy lady here, a great kissy man here who is eating ugali, very well cooked ugali, with some greens there, and maybe some protein there, and even worse, iko maziwa mala mahali. But we shall overcome. So this is what here, somebody, this is 200. And then we go to item number 2. So anytime they want us to give them the temporary difference here, you take the carrying amount minus tax base, carrying amount minus tax base, carrying amount minus what you're calling the tax base, carrying amount minus the tax base. All right. So let's continue with our statement here. So please, if you have been able to print this question, we are told here some land and buildings were revalued upwards by 50 million during the year ended 30th April 2012. Remember, revaluation does not feature in our temporary difference schedule. Revaluation will come in when you are doing that T account for the deferred tax asset or deferred tax liability. When you're doing that T account, the T account, Roman 2 of the question, that is when you bring issues to do with revaluations. Two things basically. The only foreign items you can bring to that deferred tax account, foreign items you can bring, is the revaluations of PPE and revaluations of available for sale assets. I'll be coming to that. But for now, we shall leave revaluation. In this case here, we shall postpone its application to later, to Roman 2. Revaluation will go to Roman 2, not here. All right. So then from there, ladies and gentlemen, we go to point number 2. Point number 2, what have they told us? Intangible assets consisted of trade licenses being amortized over 5 years, had a carrying amount of 60 million. This was allowed for tax purposes in full 2 years ago. So let's get back to business here. First of all, he has done me a favor. He has told me the name of the item, it's intangible assets, and he has given me the carrying amount. I mean, my work is to copy. Imagine you're being rewarded for just copying. Intangible assets. So intangible assets, in this case here, the carrying amount is what here? 60. The carrying amount is 60. Remember, how do we get, in this case here, the tax base? The tax base, ladies and gentlemen, please listen. To get the tax base, we shall always take the cost minus any accumulated wear and who, wear and tear, minus any accumulated wear and tear, or minus any accumulated allowable expense. So assuming that the cost of this intangible asset, I'm assuming here, because the carrying amount is 60, I want to make an assumption. Assuming that the cost of this intangible asset was 60, not 60, but 100. Let me use 100. What has this examiner told us about KRA? That KRA had allowed us to claim everything. So in this case here, the allowable expense for tax computation was recovered in full 2 years ago. So, ladies and gentlemen, in this case here, we have here the accumulated allowable expense here will be exactly 100. So then what would this mean regarding the tax base of this intangible? Whenever you hear that some expenditure was allowed for many years ago, straight away know that this guy has claimed everything. So then what do you think will be the tax base whenever they tell us that this expense was allowed many years ago? What do you think in this case will be the tax base? What do you think will be the tax base? Zero. For all these years I've taught this topic, I know for sure that intangible assets, even if I don't understand this concept here, intangible assets, except goodwill, intangible assets, ladies and gentlemen, the tax base will be what here? Will be zero. Why? It's because of the concept that I taught you. I told you that this taxman would want to incentivize you. Remember, intangible assets are like now those licenses, copyrights, trademarks, when you're doing research and development. So if you're doing research and development and you incur a huge cost, then the taxman would want to incentivize you by telling you, you've incurred $1 million. You recover everything this year. Because he's looking at you getting onto your feet as a business, and then in the future, he starts eating from you. You'd want to enable you start business. So intangible assets, the tax base, whatever basis of the KRA person will be using in the future will be zero because already has allowed you to claim everything. He has allowed you to claim everything. So then if that is the case, what is the temporary difference here? The temporary difference will be the carrying amount minus the tax base, which gives me what somewhere there, which gives me 60. Item number 2, gone. Gone. Item number 2, gone. Item number 2, gone. All right. So anytime we talk about tax base, be remembering about this cost minus accumulated wear and tear or minus accumulated expenditure. Very, very important. And please, as I handle these items one at a time, given the fact that they are very repetitive, ensure that you ask questions along the way. Challenge mwalimu. I'm also here to learn. I'm also here to learn. I learn every day. I learn every day. Where I work for a company that deals with financial reporting. All right. We provide financial reporting software to companies like EABL, Equity Bank, KCB. They also bought our software of group consolidation. It is many firms, and we are in 140 countries. And every day I talk about what your standards. And what I came to learn is that because we do it practically, whenever I get in touch with these accountants, I learn a lot also from them. You'll go with something, tell them we normally do it. Then they tell you, no, we do it this way. Or rather, even your method is very long. Look at this method. It's going to give you the same answer at the end of the day. And because of that, I've learned to learn so many things from what here also my students. So whenever you see, ladies and gentlemen, that my explanation is not very good, don't be afraid of writing there that, mwalimu, you've committed an ID10T error. You've committed an ID10T error. You've committed an ID10T error. ID10T error. Great. ID10T error, and I will not take any offense. Evelyn, I did not get your joke. How I wish I got your joke. I like jokes as well. Go to number 3. The company has available for sale financial assets with a carrying amount of 20 million and financial assets at fair value through P&L 10 million. Both financial assets reported losses in fair value of 2 million each as at 30th April. Very easy. Then we have got 2 types of financial assets. We have 2 types of financial assets. We have financial assets which are available for sale. And then we have got financial assets whose revaluations we shall be crediting or debiting the P&L. We call them financial assets through P&L. And then we have these other financial assets which are long-term. Long-term, we say they are financial assets through OCI. Through OCI. OCI is other comprehensive what here? Other comprehensive incomes. Of course, all of us did financial reporting at the intermediate level. I'm not asking you whether you are very good at this OCI and P&L, but just generally, do you understand the format of the income statement where we are able to talk about, for example, other comprehensive incomes? Are we conversant? I mean, not so much, but are we able to remember something about OCI? About OCI, are we able to remember something there? Oh, Ruth Nyambura, great. No, okay, great. I'm not surprised because I'm so sure that some of you don't practice this at all. At your workplaces, you don't practice at all, but we shall overcome. You see, other comprehensive incomes, we normally take revaluation of non-current assets to other comprehensive incomes. Anytime you revalue, like, for example, a PPE item, property, plant, and equipment, like you have a land, you have buildings here, you revalue them, and then there is a revaluation, for example, upwards of, say, 100 million. You can't take that 100 million and then you debit it in the income statement directly, or rather credit in the income statement directly. That will be wrong because the shareholders will stretch their hands like this to you. They would want to get what your dividends out of that revaluation gain. And you see, this revaluation gain have not yet been realized. They can only be realized when you sell that asset. When you sell that asset. All right. So if it is an item that is non-current, any revaluations has to be taken straight away to what we call other comprehensive incomes. It can't be booked in the P&L. But ladies and gentlemen, if you have financial assets that are short-term in nature, like for example, financial assets which are short-term in nature, we're looking at the treasury bills, etc. Whenever there are gains, short-term gains, those ones you share them, you give them to the P&L, all right? The short-term, you shall be booking any gains or losses in them in the P&L. But long-term assets, what we call non-current assets, we shall, ladies and gentlemen, be booking their gains, stroke losses, under what we call other comprehensive incomes. That shall become clear as we move on to other standards. Like, for example, we have IFRS 13, fair value measurement. Fair value measurement. For now, our only place that we are going to is known as Mount Elgon. And in Mount Elgon, what are we doing? It is IAS 12, income taxes. We don't want to mix things. Azimio alituambia hakuna mchanganyiko. We don't want to mix things for now. So long as you are able to see that I've got two categories of assets here. They've told us you have fair value or other financial assets which are available for sale. Just write there dash OCI. And then we have or rather, we have in this case here financial assets through P&L. Just write like that, through P&L. Let me read this again. 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 What have they told us? These guys are great people. They are telling us here, the company has available for sale financial assets with a carrying amount of 20. So this one here has got financial assets available for sale, it's 20. And then we have financial assets through P&L, they're telling us here. And the financial assets at fair value through P&L of shillings 10 million. So at least that they have given us. And then, ladies and gentlemen, they're telling us there that this was allowed, no. Both financial assets reported losses in fair value of 2 million each as at this date. I like those concepts of losses. When you see losses, who has recognized that loss? It is the accountant. The taxman will never allow you to record a loss, not unless he's able to certify it. All right. So that loss is not certified by the taxman. So what you need to do whenever you see losses that the taxman has not, for you to be able to carry forward. I mean, the taxman losses carried forward. The taxman has to look at your financials and give you a certificate against which you'll now be able to use that particular loss which has been able to certify and carry it forward, I think, for 4 years or something like that. All right. So whenever you hear that losses have been booked, you go and add them back when you're looking at the stuff from the taxman's eyes. So both of them, we are told in this case here, each lost what year? 2 million. The loss was 2 million. So then if you're following, what do you think will be the tax base of this financial asset available for sale? Financial asset available for sale, what do you think will be the tax base? 22 years. So this will be 22, and this will be what here? Somebody will be 12. Will be 12. And if you want to do this in the long way, there are students who love doing this in the long way, then you shall do it this way. You shall do it this way. You shall come and establish the cost. How do we get the cost? We know here that carrying amount equals cost minus accumulated depreciation. Depreciation is the same as loss. Depreciation is the same as loss. So for example, for the financial assets available for sale, we can see the carrying amount here is 20. The cost, I don't know the cost. I don't know how much it cost them. But fortunately, I know the loss. I know the loss is what here? The loss is 2. So from this, I will be able to get the cost. So cost will be 20 plus 2, which gives me 20 what here? Which gives me 22 like that. And once I get now this cost, I will easily be able to get the tax base. I will easily be able to get the tax base. To get the tax base here, we know we take the cost, we take the cost here, minus in this case here, any, where, and the tear certified, where, and what we call tear allowance. wear and tear allowance. So in this case here, the tax base then will be equal to the cost that you've gotten here, and there is nowhere you are seeing in this case here the taxman giving any allowance, because anytime the taxman gives an allowance, it has to be given there in the note. So no allowance has been given at all. So in this case here, the wear and the tear is 0. So in that case here, the tax base becomes what here? Becomes 22. But this is a long approach. For us, in this case here, we are ninjas. Ninjas, in this case, will always appreciate shortcuts. That we have an accountant who has made some losses there. After adjusting the losses, he got the carrying amount as 20. So we, on their side, who are now in the books of the taxman, will come and say, I mean, everybody would want to hide taxes. When somebody comes and tells you that they have made a loss, that could be a way of creating losses here for them to be able to understate their taxes. So whenever they talk of losses, tell them, before we talk about anything, please, that loss, add it back. That loss, add it back. That's how we've been able to get these 22 and 12, because we added the 2 and 2 to get the tax basis. So up to here, are we together really, first of all? Are we together up to here? Great Ninja should be able to talk to me. Great. So then you should be able to come and give me the temporary difference, and I've given you the formula of getting temporary difference. It is carrying amount minus tax base. So 20 minus 22 gives me minus 2, and then we have 10 minus 12. This gives me minus 2, like that. So ladies and gentlemen, please, I don't have a ruled book. How I wish the board was also ruled. It would have been very nice. We shall overcome. We shall overcome. All right, then if you allow me, I'll be able to move to the next concept. I told you AFRA is not a paper to fail, really. Let's go to the next one. Next one is not number 4. Inventory is shown at the lower of cost and net realizable value. The cost is shillings 800 million, while the net realizable value is 780. Remember what IAS 2 tells us. We as accountants, what does IAS 2 tell us? IAS 2 talks about inventory. IAS 2 tells us something to do with what we call inventory, recognition, measurement, etc. Inventory. Now, ladies and gentlemen, please listen and listen to me very well. So whenever we talk about IAS 2, it tells us that always, whenever you've got inventory items, look at the cost. The cost here is 800. And then ask yourself, if you were to sell this item today, it could be in the supermarket, and this thing now has become, in this case here, perishable. Could be sukuma wiki. So if you're forced to sell them today, how much will you realize? What is the net realizable value? How do we get net realizable value? We take the market value less cost to sell. So here you'll always be given the net realizable value. So in this case, it is 780. So then you as the accountant, what will you take as your carrying amount as your IAS 2 tells you? What will you take as your carrying amount between 800 and 780? It is always the lower. It is always the lower. You take the lower. You take the lower. So in this case, it means, ladies and gentlemen, that inventory carrying amount, ladies and gentlemen, here is 700 and what here? Is 780. Is 780. But do you think that's a language you can go to the taxman and convince the taxman that your inventory asset has lost 20? Do you think that is a language that the taxman would want to hear? Does the taxman want to hear anything to do with losses? Those of you who have ever dealt with the taxman, does he want to hear anything to do with losses? No, he'll not allow them. He will not allow losses. No. Remember, if you get confused in an exam, not all the cases, but in most cases, the TB will be equal to the cost. That's another secret I'm giving you, just in case you go under. You know, at times we get confused. All of us are human beings. In an exam room, you can go to an exam room like this, and then out of nowhere, you simply get things not getting right. You find yourself, in this case, you're sweating. And as I always tell you, you find yourself sweating from the wrong places. You know, when I used to be an invigilator, when I was a bit younger, right now I can see ages not on my side. All right. I've already done like half of my expected useful life is gone. Yeah. If God gives me life up to 90, already 45 is gone. All right. So in those old days when I used to be an invigilator, I think there is a big problem outside here. The fear that students handle CASNEB exams is at another level, and that is what makes them fail. Not even that they don't know. Most of us, we know a lot of this AFRA, but the fear. Like I remember one time I went straight away and placed, it was an AFM paper, Advanced Financial Management paper, in front of, you know, those days we used to give like 111. So like nowadays you go and get like everything is placed on your table. No, those days we'll go and move, give them round, because the candidates were also very few. So I gave this gentleman a paper. He was seated at the front and he was quite elderly. And please, this is something I would want to request CASNEB, these old people, please don't be putting them at the front. Be putting them at the back. Yeah, it's very important. Some of you may not be able to understand this. So this guy was about 40, 45. All right, was quite elderly compared to me that time. So I gave this guy a paper. On giving this guy a paper, and of course I went to giving other students like that. Coming back, I met this guy. I mean, he was really, really sweating. From nowhere, all his pens fell down. So I took the pens, gave the pens to him. Next minute, ladies and gentlemen, is the calculator. Pop, I took the calculator, gave it to him. Then I observed that this guy was really sweating profusely. So I called him outside. Those days, things were very nice. I called him outside and asked him, honestly speaking, must you pass in this paper? Must you get a pass? Is it a must? Is there any obligation? Is there anybody who is pushing you, is telling you that, for example, you have to pass? Is there anything that is a must in this world? Is there anything which is a must in this world? There is nothing that is what here a must. Hata kama ni bibi amekuambia sasa wewe atijui anaenda kuchukua barua yako kwa post office anakuja kukusomea. Hakuna kitu kama must in this world. So I was able to kind of mentor that young, I can see you guys are saying we talk about 40 being young. So in this case here, I was able to mentor that man. And this guy went and sat down and he relaxed. Later on, when I met him, because now we had to exchange numbers here, because I think he liked me. Maybe I'd never gotten an invigilator like me. So when we spoke later on, he told me, Mwalimu, you know what? That paper I passed. It is all about courage. CASNEB is all about courage. So, but should things in this case, ladies and gentlemen, get like crazy, then the tax base, this is something that I'm giving you, which you'll be able to use to do what you're to. Remember, in most cases, the tax base is the same as what your cost. It doesn't recognize any losses, nor what your gains. It doesn't recognize losses nor gains. All right, we shall overcome. You see, like now, this person is saying, but she saw another one last year. Yeah, you'll never forget me. We shall overcome. We shall overcome. So what am I? Hii kitu ya kuuziwa uoga na CASNEB, msiku mnaobaye uoga. CASNEB has got very many free, low-hanging water fruits kind of questions. If you just relax a little bit, breathe in during an exam, you will really pass these papers. Trust you me. All right. You can see like right now you are handling this question almost yourselves. So like in inventory, you've told me, Mwalimu, inventory, it'll be pegged on cost. Because this guy has recorded a loss of 20, please add that loss back. So it gives me a temporary difference of what there, a temporary difference of 20. All right. We shall overcome. We shall overcome. Now, so please get back there. We are told receivables had a carrying amount of fiber. Let's record the receivables first of all. Let's record these receivables. Let's record them. So receivables had a carrying amount of 500. Now that you guys have become experts, let me pause here and see whether there is anybody, even a single student, who should be able to give me a tax base here. After making an allowance for doubtful debt of 20 million, and an exchange gain of 40 million, unrealized. Both the allowance and exchange gain are not allowed for tax purposes. What do you think in this case is the carrying amount here, ladies and gentlemen? What do you think is the carrying amount here? So as you calculate this carrying amount, I recognize the fact that we have got so many visitors around. If you'd want to join RCM Online College, please do so. Don't hesitate. Call us like today. Our number is 0793 555 000. 0793 555 000. We are charging Kenya shillings 4,800 per paper. That amount is non-negotiable. Non-negotiable. If you get schools that keep on negotiating fees, they are not very good. I'm the one who is teaching you sustainability reporting, sustainability discounts. In this case here, destroy very, very many companies, not unless they are really very well calculated. So is there somebody who is able to give me the carrying amount here? Really, nobody has been able to give me the carrying amount. You see, not unless it's a specific doubtful debt, if they're just general, then those ones, ladies and gentlemen, you should be able to add them back. So like what I'll do here, I'll take the 500, add back this doubtful debt, and subtract this exchange gain this guy had booked in. You subtract. So it will be 500 plus the loss, 500 here plus the loss of 20 minus that exchange gain of 40. So this one here gives me how much, ladies and gentlemen, as a tax base. I did not read the comments. There are so many which are correct. I will repeat, yes. I will repeat. So it gives me 400. Is it 480 or 520? Pata potea. It should be 400 and what here, somebody? I can't see the board. Okay, I'll be able to do something. 480. 480. They can't see the board here. What I will do, I can lift it a little bit up. Like that, they copy, and then I know what to do next. Before I repeat, have they been able to copy there? Have they been able to copy there? Have they been able to copy up to there? I hope they've been able to copy up to there. Abracadabra. All right. And then now I can do some abracadabra to ensure that they follow very well. I can come and create my board up here. And then I'll repeat here. You see, the carrying amount in this case, ladies and gentlemen, is what here? The carrying amount is 500 for the receivables. Carrying amount is 5. But this is after they have accounted for a loss of what? 20. Of course, when they were accounting for the loss of 20 themselves, what did they do? They subtracted. So in this case here, for us to make good, we add back. Losses are always added back. Losses. So in this case here, come and add back losses, and there is an exchange gain. There is an exchange gain of 40. What do we do with this exchange gain, which the accountant hitherto had added? Now they're realizing that it was not even realized. We don't want to tax these people over unrealized gains. So what do? We shall come and do what? Yes, sir? Subtract. We shall come and subtract, which in this case will give us that 480. So once you get the 480, then you should be able to get the temporary difference, which will be 500 minus 480, which gives us what here? Inventory, temporary difference is negative 20 in inventory. It's negative 20, you are right. I missed this out. Thank you so much. So somebody is also telling me that this one should be 20. This one here should be 20 positive. Evelyn, how did you get negative 20? Remember, it's 500 minus 480. I would rather repeat this severally until everybody is comfortable with it. Or for inventory, yes. Thanks, Evelyn. For inventory, yes. I would rather repeat this severally until, because when you see losses, what do you know? The accountant had subtracted. The taxman does not allow losses, add back. add back. Any gains that this guy had added and we want to cancel it, we subtract. Philip is asking a very good question. What if in this case here that exchange, or rather, what if that exchange gain was realized? So if it was realized, then we would not have cancelled it, because then the taxman has got every right to do what, to claim his tax on it. But in most cases, all the questions I've seen, whenever they mention it there, they'll always tell you exchange gain unrealized, or they can also choose to be quiet about it. If they're quiet, the better thing to do is to assume that they are unrealized. Knock it away. You know, it is the opposite here. Somebody may argue, Molly, but exchange gain should be added. You see, that is what the accountant did. And you are undoing what the mess that the accountant did. So if he added, what do? We subtract ourselves. All right. So can I go to something different? 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 Yes. Thank you, Lonida. All right. So the last one now. This one I should keep quiet. I'm 100% sure that all my great students who are this time round in Mount Elgon, remember that is the city. I should call it city, but our hiding place for this topic is Mount Elgon. And the people from Mount Elgon, you guys may not be knowing, people from Mount Elgon are tough people, very nice people. So you guys from Mount Elgon, that's how I'm calling you today from your area, Mount Elgon people. Trade and other payables are stated at 900 after making provision for a discount of 10 million. So now what I would want to see is seeing you guys doing the abracadabra, right? Trade and other payables. What is the carrying amount? Is there anybody who is able to see the carrying amount? For trade and payables? And other payables, I mean. Carrying amount. These are the figures that we are stating these things in our financial statements. So carrying amount has to be this 900. But the tax base, I'm so sure the tax base, ladies and gentlemen, is not many of us will be able to get the tax base. Is the tax base 890 or 910? The tax base, is it 890 or 910? Thank you so much. I can see so many comments. Tax base is 910 years. 910 years. Because you see, this is after making the provision, after making that allowance. So he subtracted. So as we want to undo that, we add back. So it becomes 910, which gives me what figure? Somebody has a temporary difference. Which gives me what figure as a temporary difference? Uongo, Bekilizi, uongo. Remember, payables are liabilities. We must always put them in brackets, or you get a zero. All the others were what here were assets. It is only this one that is a liability. Liability items must always be put what here? Must always be put in brackets. They are negatives. So when you subtract them, remember this is negative 900. So you take negative 900 minus this minus 910. So it gives me 10 like that. Then can you kindly do me a favor? Please add all of them. And I'm writing up here with a lot of humility. It's because my board was not big enough. I should not get a student doing something funny. They're writing on top as well. So please add for me this entire column. Give me the total temporary difference. Is there somebody who has that figure? Total temporary difference. Positive, isn't it? Grabbed it, but no problem. So total temporary difference. So total temporary difference, I'm being given a figure of 266. Is that okay? Is that okay? 266, is that okay? Thank you so much, yes. And because it's positive, it means you must pay tax upon it. It's positive. You have to pay tax upon it. So when it's positive, you're paying tax upon it. It's called a taxable TD. It's called a taxable TD, a taxable temporary difference. If it was negative, then the taxman would have allowed you to go and claim, or you push it as an asset. If it was negative, I would have called it a deductible. Deductible because it's negative. Deductible temporary difference. I'll be able to bring those terms later, but for now, just appreciate that because it's positive like profit, you're going to pay tax. So it becomes a taxable temporary difference. So then please go ahead and because it's taxable, go ahead and create a deferred tax liability. This will be deferred tax liability. So deferred tax liability. So deferred tax liability carried forward. Carried forward. Carried forward. So are you able to calculate this? 266 times 30%. 266 times 30%. So then this gives us what figure? 79.8. I'm being given a figure of 79.8. Is that okay? 79.8. Thank you very much. That is the end of question 1. That is the end of question 1. End of question 1. Roman 1. End of Roman 1. End of Roman 1. End of Roman 1. Where they wanted us, ladies and gentlemen, to compute the relevant temporary differences. And then now we can go ahead and do Roman 2, where they want us to show the journal entry to record changes in the deferred tax liability. Liability, very good. Let's do a deferred tax account. 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 So remember, we have a deferred tax that was given to us at the beginning. A deferred tax that was given to us at the very beginning. Here, Lamy Limited had a deferred tax and it's a liability as at May 2011 of 100 million. So deferred tax liability brought forward. This will be on the credit side. If you remember the concept of payables, like this. Liability share, capital revenue, credit balances. So balance brought forward. Balance brought forward 100 million. And then we have balance carried forward. Balance carried forward, we have 79.8. This figure here. This figure here. All right. All right. Now, of course, we have the changes there. The changes here, ladies and gentlemen. The changes, ladies and gentlemen, that we have here, you'll straight away remember that the changes are only coming from 2 places. Revaluations of our PPE and any gains or losses on available for sale assets. 2 places. 2 places. The revaluations on PPE. So we ask ourselves, did we revalue any PPE in the year? Did we revalue any PPE in the year? Did we revalue any PPE in the year? You can see here, some land and buildings were revalued upwards by 50 million during the year 30th April. 50 upwards. So upwards means what? That the taxman will come to claim something from you. So it's a liability. So liability will be credited here. So we have here revaluation of PPE. Revaluation of PPE. So 30% of the 50 million. 30% of the 50 million, which gives me how much? 30% of the 50 million, which gives me how much? 15. Thank you very much. Do we have any loss? Like in this case here, remember we have a loss of available for sale asset. Are you able to remember that loss? Available for sale. How much was it? Available for sale. How much was it? Available for sale. How much was it? And it's a loss. So if it's a loss, it's a deductible. So you should be able to bring it here. You're claiming it against your tax liabilities. So we have here loss on available for sale. It was 2 million. You take 30% of that, which gives me 0.6. So then you should be able to give me the bigger part. So the bigger part, what do we have here? I think it's 115 here. It's 115 there. So in this case, the balancing figure will be 115 minus this minus this. Are you able to give me the P and the L? Are you able to give me the P and the L? Balance 115 minus this. So remember, the standard tells us whenever we are doing this deferred tax account, the changes there. We need to bring in revaluations of long-term assets. And long-term assets, we're looking at PPE and any asset which is available for sale. Available for sale. So Kasmal is giving me 34.6. Thank you very much. 34.6. And he has known that this is an income. Why? Because we are debiting. So we are debiting here. We are debiting, debit, the P and not debit, debit deferred tax account. And then you credit P and L. With how much here, somebody? 34.6. 34.6, like that. That is a journal that they expected you to do what here? Pardon the debit side, no problem. So in this case here, remember, the credit side here is bigger. 100 plus 15 gave us 115. So then here we should have 115. Then how do we get the balancing figure? You'll take 115 minus what you already have here, minus this 0.6. That's how we got the 34.6. Mary, just get your calculator there. You will take this minus this minus this. Give me an answer. So it's an income because it's being credited to the P and the L. So it's a deferred tax income. It should be a deferred tax income. All right. So can we go to a different question? May 2017? Because of time, can we go to a different question? We try a different question. We see how it goes. Network problem. So Paul, what we have done here, you see, I hope you're able to remember we had a balance carried forward of 79.8. I hope you're able to remember a balance carried forward of 79.8, which you calculated from the deferred tax temporary differences up there. And then we have the balance brought forward, which is given in the question here. Balance brought forward is given in the question. It's a liability. Balance brought forward here of 100 million. So because it's a liability, we shall put it on the credit side. Balance brought forward 100. And then now from there, we know that this deferred tax account, you must always look for two things as per the standard. You must look for the revaluations on what here? On PPE, which in this case here was an upward revaluation. So if it's an upward revaluation, that's a gain. So gain on PPE, it is 50 here times 30% the tax rate. So you got the 15. And then we have in this case here gain or loss on available for sale. Available for sale. If available for sale had a gain of say 2 million, it would have been on the credit side, 30% of the 2 million. But remember the available for sale, we happen to be having a loss of 2 million. So the loss is booked here. Because you see, loss you're going to claim from the taxman. It's like an asset for you. So you debit this account. So loss on the available for sale, you take the 2 million times 30%, you get that 0.6, and then you'll be able to get, ladies and gentlemen, our what here? Our balancing figure. So how do we get our balancing figure? This 115 is bigger, 115. So 115 minus this. We got 34.6, and then we have our journal entry there. So I hope Paul have, of course, moved a bit fast, but I hope that is helpful. And then, of course, you'll be able to get, somebody saying there that it looks like we have double counted. It looks like we have double counted the AFS. No. You'll be able to understand this better in this May 2017 question. May 2017 question. All right. So have you guys gotten that question on deferred tax? Let me get it. So it is May 2017, question number 4B. We didn't get sent the question here, question number 4B. And if you're careful, if you're keen enough, you realize that May 2017, question number 4B was repeated word by word by CASNEB. CASNEB is a good examination body. It was repeated in the November sitting, November 2019, question 5B, word by word, repeated, word by word. November 2019, word by word. All right. So then if you allow Mwalimu here, Mwalimu has this question as well. So Mwalimu will be able to retrieve the question. And then we go through it. It's called Munro. Increase the font. So it's here. It's called Munro Limited, a manufacturing company, provides for deferred income tax in accordance with IAS what year? 12. Income taxes. The following is an extract from the statement of financial position as at 30th April 2017. So we have our assets there. We have our current assets. Great question, really. Additional information. The tax bases of the assets are as follows. Note 2, note 3, note 4, note 5, note 6, all the way. Then they want us to give them the deferred tax balance as at 30th April 2017, 12 marks. So they would want us to give them the schedule of temporary differences first. And then they want us to give them the deferred income tax account as at 30th April 2017. 30th April 2017. All right. So then, ladies and gentlemen, this is what we have here. Let's mention there. Let's mention there. Temporary differences schedule. Okay, so we have our items, we have our carrying amount, we have our tax base, and then we have our TDs. We have our TDs like that. Okay, so are we there? We've been able to draw this table really. Once you draw the table, please put your thumbs up like this, live. Put your thumbs up, live. Put your thumbs up, live. And how I wish the students who are following me on Facebook that I'm seeing there are many there, how I wish they would also go ahead and share that particular video. Share that video, because I know so many students are struggling with their far outs idea for nothing. And it's an easy paper for nothing. Why should you struggle? No, just get the right teachers. We are here for you. We are here for you. Great. So then we go straight away these notes one at a time. So we start with note 1, the tax. They have given us the tax. Let's first of all handle this. They've given us the tax bases there very well. So we have here property PPE. Item number 1 is PPE. Item number 2 there is prepayments. Prepayments. Then item number 3 is interest-bearing loans. Interest-bearing loans. And then we have financial assets available for sale. So we have financial assets available for sale. Financial assets available for sale. So I'll simply copy those figures under the TBs. 2,800. Prepayments, what do we have there? Prepayments. 1,500. Prepayments are 1,500. From there, we have interest-bearing loans, 17,000. 17,000. From there, we have FA available for sale, 14,000. There was a slight mistake there. You should have just mentioned there the tax basis of the items, because you can see like the interest-bearing loans, these are liabilities. They're not assets. But I mean, that cannot deny us getting marks. Let's really get ahead and now get the carrying amounts of these items. We start with the property, plant, and equipment in the statement of financial position. Property, plant, and equipment, I can see 14,000. Prepayments and the current assets. You can see prepayments, 3,200. 3,200. Interest-bearing loans. These are loans, so we shall look for them. These are loans. They can only be obtained here. And on current liabilities, you can see interest-bearing loans, 16,000. Carrying amount, 16,000. Carrying amount, 16,000. 16,000. All right. And then we have financial assets available for sale. Financial assets available for sale. Financial assets available for sale. These are long-term assets, really. So financial assets available for sale, 12,000. So could you kindly then give me these temporary differences? Don't forget that the interest-bearing loans are liabilities, and as such, put the figures in brackets. Honestly speaking, you guys, I would want us to be very honest with each other. Is this very technical? Is this very, very technical? Because I get students sweating with their deferred tax. Is this technical really? Is it very technical? No, it's doable. Very much doable. Copy and paste, yes. So please give me the temporary differences on the other side. Temporary differences on the other side. 11,200, the first one. 11,200, positive. The second one. Oh, at least I'm getting a student here saying, for the first time I've understood. Great. And that's RCM for you. Great. 1,700, positive. Please here be very, very careful. And then I also have a shortcut. The shortcut, which I normally use myself, so that I don't forget, I'll just take 16,000 minus 17,000, but reverse the sign I get. So like I'll take 16,000 minus 17,000, I'm getting negative 1,000, but I reverse the sign. So instead of writing negative, I write 1,000. Is there somebody who is able to get that shortcut, really? Instead of writing minus, then you end up getting negative 0. There's a big shortcut here. For liabilities, you can just take the 16,000 minus 7. The answer you get, you change the sign. I know you guys are bright, have picked that up. I know, or times minus 1, yes. Also say times minus 1, yes. Times minus 1. So AFS, I'm being given a figure of 2,000 negative. Thank you so much. Don't take your calculator and you start giving us the total. No. No. That's just an error. They said an asset, but it's an error. trust you, that's an error. It's supposed to be what your liability. Don't give me the total yet, Abdi. Don't give me the total yet. We go to note number 2. Let's go to note number. It is not that easy, Abdi. Note number 2. Inventories are stated at fair value less cost to sell, which is lower than the original cost, due to a general provision for price decline of 3,500. Remember, our figures are being captured in shillings thousands, so you must also capture your amount in shillings thousands. So this is the same as 3,500. So please look for inventory in the balance sheet. Inventory is 75. But now remember, there is a general provision there. So inventory is 75, but there is a general provision of 3,500. What do you think will be the tax base? What do you think will be the tax base? Note 8. I'm being given some note there. What do you think is the tax base? No, you can't go to note 8 first. So you see there is a general provision which this guy will never allow. Add back. That gives us what somebody there, that gives, and I'm so happy because I can see most of us are getting it right. 11,000. So we have here 11,000. So then what is 7,500 minus 11,000? It is that 3,500 negative. All right. So then we go to the next one. Now you guys are becoming professionals now here. We go to number 3. The intangible assets comprise development cost, which is tax deductible when the amount is paid out. The cost of the intangible asset was paid in the year 2014 and is presented net of amortization cost. Let's look for intangible assets here. Under then current assets, I can see intangible. You see the carrying amount already has been given to us. The carrying amount is already given to us. Intangible, I can see here intangible is 6,000. So we have intangible. Intangible is 6,000. What do you think from the language given there will be the value of the TB for these intangible assets? For intangible assets, what do you think will be the TB for the intangible assets? The TB for the intangible assets. Is it 4,000? Is it 4,000? Intangible 4,000. They're saying intangible should be 4,000, not 6K. Sorry for that. Let's look at it well. Intangible assets is 4,000. You're right. So intangible assets is 4,000. Thank you very much. Thank you very much. And then in the TB, because they were provided for in full, automatically intangible assets will always have their TB being what here? 0. So then that gives me 4,000 as a temporary difference, So up to here, are we really together? Up to here, are we together? Thank you very much for the correction. It's 4,000, not 6,000. I just looked at it wrongly. Thank you so much. So we go to the next one. If I share my screen here, let's go to the next one. So the next one, they're telling us here in the next note, they are talking about goodwill and the employee benefits are tax exempt. So if they are tax exempt, what do we do with them? If they're tax exempt, what do we do with them? Those are the ones that give forth to what we called permanent differences. They shall not be put in this table. Don't put them in this table. If they're tax exempt, these are table of taxes, remember. So if they're tax exempt, we shall not be working with them here. Great. They're tax exempt. We ignore them. Achana nayo. I like that language. Very good. Now from there, we go to the next one. Trade and other payables include provision for leave allowance of 1,400, which is tax deductible on cash basis. They include provision for leave allowance of 1,400. So look for trade and other payables. trade and other payables in the liabilities here, 8,000. So for Mwalimu, he has to keep on writing on top because students can't see my board down there. So we have here trade and other payables. Trade and other payables. So the carrying amount here in a shida, carrying amount only 8,000. But from your understanding, then what do you think in this case here will be the TB? What do you think will be the TB from how you are understanding this? What do you think will be the TB? What do you think will be the TB? Will it be 9,400 or 6,600? Pata potea, please be yourself here. Talk to me. Talk to me. Talk to me. Talk to me. $6,600, you're right. Because including means what here? You know, including means they have added. They have added. Includes, they have added. And the provisions are not supposed to be there. So deduct. So you're right. So trade and other payables, 6,600. So giving us what difference here, somebody? 1,400. But now remember, these are payables. Liabilities. So this like this. Like this. So minus there. Minus there. And then somebody's asking, why are the intangibles in this case here? TB 0. 0. Remember, I gave you the formula for TB. I told you that TB is cost minus accumulated wear and tear. Now, assuming that the cost, assuming I'm just making an assumption for this intangible, assuming the cost is 4,000. This KRA guy, we are told, had allowed you long time ago to claim everything in full. You're able to claim in full. Just read this. Read this. Read this. Read this. Read this. Just read this. Here. Here. The intangible assets comprise development cost, which is tax deductible when the amount is paid out. When you paid out like this, you claimed immediately. You claimed immediately. The cost of intangible assets was paid in the year 2014. You can see it was paid already. So it was paid and claimed. And I also gave you another way of just remembering this. Normally, KRA would want to incentivize you to get into business. So as an incentive, they'll tell you, you incur the cost and claim everything 100% and claim everything 100%. That's why the TB is always 0. The TB is always 0. Now, if you allow me, I'll be able to go to the very last one now. To the very last one now. So the very last one here we are told, no, there's still 7 and 8. Trade receivables are stated net of general allowances for bad debts at the rate of 5% of the gross receivables. The general allowance is not tax deductible until it becomes what is specific. General allowances, they can never be allowed by the taxman. So in this case here, we have the trade receivables. Abracadabra, this is not an easy one. But because we are coming from Mount Elgon, then we'll be able to understand everything. So go ahead, ladies and gentlemen, here and calculate for us trade receivables. Trade receivables. Trade receivables. So trade receivables, fortunately, the carrying amount is 6,500. That one is not in doubt. That one is not in doubt. But what about, ladies and gentlemen, these guys? This thing here of 5% of the gross receivable. 5% of the gross. So it is net of general allowances for bad debts at the rate of 5% of the gross receivable. So remember that these receivables, the receivables are how much? The receivables, they are 6650 actually, I'm wrong. The receivables are 6650. Receivables are 6650. Yeah, 6650. Receivables. 6650. But you see, this 6650 is net of 5%. Net of 5%. Is net of 5%, but 5%. But that's 5%. So it means that 6650 is at 95%. Now, because the 5% is disallowed, I would want to add it back. So please come and tell me what is 100%. When we mark these exams, so many students will compute 6650 times 5%. So many guys. 6650 times 5%. No. It's a net of 5%. So then can you kindly cross multiply and give me the gross amount? Cross multiply and give me the gross amount. What do we have there? 7,000. 7,000 here. Because the taxman will just take it at 100%. He'll not allow you to deduct that 5%. No. No. So then can you kindly, because this is an asset, go ahead and give me this amount here. Please go ahead and give me this amount. It must be 350 negative, if I'm not wrong. The temporary difference. It must be negative, right? If you miss out on that again, Mary, utakuwa na problem kidogo tu. You'll be having a small problem. So is this one here correct? 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 Vero, all right. So the very last one now, because I know note 8 is a useless one. The very last one now, note 7. The building, which is included in PPE, was revalued during the year. The increase in value of 3 million does not affect the tax base. Does not affect the tax base. The person who was talking about double counting. Remember, this 3 million is well within the carrying amount. Is well within the carrying amount. Is well within that carrying amount. Now, so where do we take these 3 million, which in this case here is as a result of what year? Revaluation. The building, which is included in PPE, was revalued during the year. The increase is in value is 3 million. It's 3,000 actually. All right. So this one, of course, will not affect us here. The tax base of other items is like that. The tax rate is like that. So you great guys, go ahead and give me the total then. Go ahead and give me the total. Go ahead. Go ahead and give me, thank you very much, Kasmal. Go ahead and give me the total temporary difference. Go ahead and give me the total temporary difference. It's on Facebook. This one is on Facebook. The total temporary difference. The total temporary difference. Is there somebody who is able to add everything and give me the total? Anybody who is able to add everything and give me the total? So remember, we have got 2 types of classes. We have early morning classes that I teach 5 a.m. to 7 a.m. And then we have the evening classes. Evening classes. That's the good thing that you will also get at RCM. You get to choose between early morning and evening. Early morning and evening. Early morning and evening. You get to choose between early morning and evening. So is there somebody who has this total? 10,650 Nancy Chep. 10,650. Are you sure? Yes. 10,650 is the total temporary difference when you add the column. Total temporary difference. So total temporary difference is 10,650. Therefore, the deferred tax, it will be a liability because it's taxable. Liability carried forward will be 30% times 10,650, which gives you guys what amount? 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 3195. 3195. There is a student who has a problem with the inventory, which we need to repeat. Unfortunately, I've rubbed, but we can always repeat here. It's very easy. Inventory. Here. Inventories are stated at fair value, less cost to sell, which is lower than the original cost due to a general provision for decline. So we expected the inventory amounts to decline by 3,500. So we reduce that value ourselves. But the taxman will not allow for that loss. So you must add back. So then what would that mean is that we'll take here the carrying amount. You'll take the carrying amount of inventories of 7,500. You add the loss, which this accountant had factored in. You add back. All right. Then from there, ladies and gentlemen, you should be able to do the deferred tax account. You should be able to do the deferred tax account. So this is the deferred tax account. Deferred tax account. There is a liability there, balance brought down. So balance brought down, it's been given in the balance sheet. Deferred income tax. Under liabilities, you can see under liabilities, it is 16,000. 16,000 here. And then we have balance carried down. Balance carried down. Balance carried down is 3195. And then we have got our two items, revaluations. Yes, we have a revaluation of PPE. We have a revaluation of PPE. Do we know the revalued amount? Do we know the revalued amount? Okay, revalued amount is how much? I'm going to repeat, Frida. Revalued amount. Note 7. The building which is included in PPE was revalued during the year. The increase in value of 3 million does not affect the tax base, does not work with what here somebody does not go into the temporary differences. It can only come here in this deferred tax account. So it will be 30% times 3,000. 30% times 3,000. So then this gives me how much somebody. Remember our figures, they chop 3 zeros, we shall chop 3 zeros throughout. So 30% of 3,000 gives me how much? 900. Do we have any available for sale item? And if we have, did we recognize a gain or a loss on it? Any available for sale? Do we have it? Just go to your temporary differences. Do we have available for sale? Unfortunately, I rubbed mine. Do we have available for sale? How much is the gain or loss? Please mention if it's gain. Tell us the gain of this much. Available for sale. Available for sale. Available for sale. $2,000. Is it gain or loss? Kasmali? Kasmol. So it's loss, right? So if it's loss, then it comes here. So we have loss. Loss on available for sale, 2,000 times 30%, which gives me 600. So please come there and balance. Which side is heavier? This time around it is this side, 37.95. 37.95. So in this case here we have P and L. P and L of how much? D is 1,200. I'm being told it's 1,200. I don't know. 1,200. Sure. Maybe I don't get what you said there, that D is 1,200. Remember, it's available for who? Available for sale and revaluation of PPE that can only come here. That can only come here. That can only come here. Or balance brought forward. Balance brought forward. Balance brought forward. Is it not 16,000? Is it not 16,000 balance brought forward? 6,900. Or the deferred income, 1,200. Hey, ngoja kidogo. How about this ma 31.95? How about this ma 31? Oh, maybe I'm the one who is now, I think, tired. Because honestly, 6,900 is bigger. 6,900 here is bigger, honestly. 6,900 is bigger. And then what is the balancing figure now? I will stop it there because you guys have understood the major. We check the balance sheet. Let's check the balance sheet. Let's check the balance sheet, but we need to stop it there because we have another class, and let's check the balance sheet here. Deferred income tax, 1st May 2016 is 1,200. 1,200, you're right. So this is 1,200. Sorry for that. This is 1,200. So then can you kindly give me the bigger side? Give me the bigger side now. So this and that, which one is the bigger side? Which one now is the bigger side? Which one is the bigger side now? Which one is the bigger side? Now I can see what Mary was telling me, but now Mary did not come out clearly tell me, Mwalimu, you are wrong. So the bigger side is 37.95. So we have here 37.95. 37.95. So the balancing figure, which is the P&L, will be 37.95 minus 900 minus 1,200. 1695. 1695. So then the journal entries, never asked about the journal entries, but if they did, I would have said straight away journal entries. Journal entries. The journal entries here would have been to debit, and then we credit. So here we are debiting the P&L. You debit the P&L with this 1695, and then you credit the deferred tax account with that 1695, and you're done. And you're done, 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 and you're done. And then now remember, if you look at the marking schemes, which I normally faithfully share with you, actually I shall start now sharing with you those marking schemes. You don't have to get up to here. You're surprised all those marks will be under by making very few entries. Very few entries. You'll see like any 6 at 2, 12 marks. 12 marks. Like when you bring down this correctly is a mark. When you take this down correctly is a mark, even if you miss it out inside. Ladies and gentlemen, it has been a pleasure hosting you this afternoon. I've really enjoyed being with you at Mount Elgon. So I'm looking forward to meeting you guys tomorrow in the morning, where we shall be able to do one more question in this area, and then we take on a different topic, which is impairment of assets. So from me to you, it's bye-bye. And enjoy, of course, the rest of what year? The Sunday. Employee benefits, they told us the employee benefits up there. Employee benefits are tax exempt. They're tax exempt. They told us up here. Anything that is tax exempt, we don't bring. They told us somewhere here. Anything which is tax exempt, they told us somewhere. We don't bring. All right. All right. Thank you so much. The current tax, remember when you're computing now what you'll take to end of year tax, I'll be coming to that. You'll take in this case the deferred tax liability plus the current tax, the deferred tax expense plus the current tax. I'll be able to bring that to you later. All right. Niko sawa sasa. Great, great. And I believe all the new students will be able now to make a decision to join us. A question for assignment, maybe you should try this one, which they brought on November 2019, and tell me whether there are differences. November 2019, question number 5B. All right, let Mwalimu now run away. Mwalimu needs also to take lunch now. Bye, bye. You see, I'm not multitasking. Some of you are eating as they were studying AFR. I deferred my lunch.